Hey everyone, in today's video, I'm going to be talking about some recent changes I've been making in my $208,000 Wealthsimple portfolio. The portfolio has been stagnant around the $210,000 mark for a few weeks here as the market's gone through some turbulence, but I have been making a couple moves in terms of stocks I've moved into and out of within this portfolio. So I'm going to get into that in this video, going to give some background as to why I'm doing those things in this video as well, so should be a good one. If you like this type of content, be sure to hit the thumbs up button. It helps a ton with the channel. So just getting into this one, for those of you who aren't familiar with my portfolio, I'll link in the description a broader overview. I did a 50-minute review stock by stock, but in this video, just going to do a quick high-level check-in here on my Canadian portfolio over the last 2 years. It's only up about 2% here. That's mostly because I'm down 5% in the last 3 months. So pretty bad performance, bad trends. In the last 1 month, my Canadian stock portfolio is down over $5,500. On the US side, it's been a bit of a different story. I'm flat over the last month, and all time, I'm actually up about 8,000 US dollars or 18%. So where the first kind of moves I've been making have been in the Canadian side of my portfolio. So I built a lot of cash over the last handful of months that you see here, up to 420 shares in cash over $20,000, because I've actually liquidated a few positions on the Canadian side of my portfolio. And the reason I did this was mostly tax purposes. So I had a couple stocks that paid ineligible dividends. Lots of viewers kind of push me to better understand and look into eligible versus ineligible dividends, since this is a unregistered account. And I actually ended up learning a lot, made a couple moves based off of it. So I liquidated some of my high dividend paying or high distribution paying stocks that were ineligible dividends, whereas paying a high tax rate on those income, on that income. And I moved that income into more registered accounts like RSPs, TFSA. So I'll go through that in a minute, but I put lots of that money into cash until I realize what I'm going to do with that money. So that's why I'm up to over $21,000 in cash. $21,000 in cash. Cash is paying just over 5% dividend a year. I think just over 20 cents a share, which I'll check right here. Yeah, paying about 20 cents a share. So I'm getting about $90 a month on this, give or take, in cash. So over $1,000 a year on this cash position. But it's not really meant to be a long-term hold or anything like that. It's just not a bad place to be parking cash with the markets where they currently are. In terms of actual stocks I've been adding to, Bank of Nova Scotia is one. I haven't been adding to it hugely, but I started buying more shares, went from like 30 to 45 shares. And it's one I'm looking to continue to add to in this portfolio as I get more capital put into the portfolio, as well as just dividends being paid throughout the rest of my holdings. This is a stock that's paying a really nice dividend, so I'm getting a 6.5% starting yield. And long term, they've really done a great job of increasing their dividend. Really stable company for the most part. Obviously follows the macro cycle, given it's a bank, so it's really consumer impacted. But even over the last 5 years, where this company's admittedly had a really challenging 5-year stint here, stock is down 17%. But even over that 5-year span, they've increased their earnings per share. Their dividend has gone from 85 cents a quarter to $1.06 a quarter. So up about 25% between 2019 and 2023. And that was even with a year that they weren't legally allowed to increase their dividend because some of the laws the Canadian government put into place over COVID. So I think this one's going to continue increasing their dividend over time, regardless of where the stock price goes. The fundamental business is still doing okay, even though it's under a bit of weakness right now, trading about 8 to 9 times next year's earnings. So this is one that I'm trying to get a bit more exposure into. In terms of another position that I've been adding to, it has been JWELL. JWELL, which is Jameson Wellness, was actually a stock that I recently added to the portfolio entirely. And I actually bought a few more shares today, up to just 20 shares here. But as it continues to go down, happy to buy more and more of this stock here. Just looking at JWELL long term, they've done a really good job of growing their business. 13, 14 years ago, the stock was doing under $200 million of revenue. Organically, for the most part, they had some tuck-in acquisitions, but got to over 400 million of revenue, 400 to 500 million over the last few years. And then they had an acquisition in the last year, which is propelling their guidance up closer to $700 million. But if you look on the right-hand side, really strong CAGR on top-line growth, and they've had similar CAGRs on bottom line as well. So really like the company, think long-term they'll do well, even though they've come into a bit of a speed bump here. Looking at their total revenues, you can see here the United States is really where they made their acquisition. So should be about $68 million impact in the base year. But next year when they have all of it, or this year when they have all of it, it's going to be more like $150 million in revenue. And then you can see here as well in terms of the growth rate in an organic fashion and then to the business, since it was pretty much completely incremental to them in terms of earnings or revenue standpoint. Adjusted EPS is one of the reasons why I think the share price came down. They guided down from 160 to 170 this year to $1.55, which if I took that as a price to earnings is about 17 times. And then for next year, they just had it at a couple % growth. So they're having a bit of a slowdown, but I think long term, they'll be just fine, and we're getting it at a cheaper valuation here. So I'm all for it. I'm going to keep averaging into it. A couple other stocks that I've just been nibbling on a bit more. Keg Royalty, this is one that's been down, I think in the last month or last little bit, 10% off of where it was trading before. It was trading at $16.50 here, now down to $15, getting over around a 7.5% dividend yield paid out monthly. So I've built up another 15, 20 shares in this position here just to get a couple more dollars a month in distributions. And then another stock that I've bought a bit more of has been Diversified Royalty Corp. Just has been really stable as the rest of the market has been really volatile, a bit immune to labor increases and stuff like that, since it's just a top line royalty fund. And I kind of like how over 50% of their revenue is coming from Mr. Lube. And as cars get more expensive or longer wait times for cars, more and more people are just waiting and repairing their existing older car, which I think adds some safety and protection in Mr. Lube revenue, despite if pricing goes up or what may happen with the economy. So this one's paying me over an 8% dividend yield. I think it's a pretty attractive, they have some pretty attractive underlying trademarks and assets. So I don't mind kind of nibbling on this one. With that being said, overall pretty small company, just a $400 million market cap, primarily exposed to Canada. So I try not to over invest in those maybe more risky companies given size or geographies. Okay, so I mentioned earlier I had over $20,000 in cash. A couple of the stocks that I sold out of in my Wealthsimple account. The first one was ZWB, which was a cover call ETF on the Canadian banks. This one was paying almost an 8% distribution, and I don't believe these were eligible dividends. So I was paying a very high tax rate on that 8%. And I'm really counting on the dividend on these covered call ETFs to pay me my return, because the underlying asset doesn't really go up very much since you're selling the premiums. So if my 8% dividend turns into just half of that or whatnot after tax, then I'm really not getting a very good return on these investments relative to what I could be in a registered account. So I moved this one over into my TFSA account. Another one that I moved over into my RSP account was actually Ryokan. So Ryokan, 5.4% dividend yield, so a pretty healthy payout. And the other thing with the Ryokan was I was down on the position. So in addition to moving over those distributions, paying less ineligible taxes on those dividends, since now it's in a tax-free account until I retire at least. Now, in addition to those savings, I also get the capital loss from selling at a loss, where I didn't really sell because I sold in this account, bought fresh in another account. So I got a lower cost basis in an account where I don't have to worry about taxes for a very long time. And then the last one that I made a notable change in was A&W Royalty. So this one, I had 530 shares in this account. I sold 130 shares, bought them in my TFSA. On this account here, I still really like the company, giving me a 5.7% yield. But the stock was down at the time about 8-9%. And this yield is also ineligible dividends. So the combination of those two things, the opportunity to get a bit of a capital loss in my unregistered account where I can get some tax rebate for it or offset other capital gains, and then also move some dividend income over into my TFSA, was an opportunity that I liked. So that's why I kind of did that move. And I can honestly see myself moving much more of this position, still over $13,000 here. I can still see myself moving more of that 400 shares into my registered accounts, whether that be TFSA or RRSP over the next year or so, depending on how much capital losses I can get from it in this account and some other factors as well. Okay, so in terms of what I'm buying more of in this account, one stock that is going to be more like the stocks I probably continue to add to this account are my positions that don't pay dividends. So I don't really have to manage with the taxes, and I plan to hold lots of my stocks for a very long period of time. So the capital gains down the road don't really scare me too much today. It's more the dividends that I pay taxes for proactively on a year in, year out basis. So Google is a stock that I really like. Have owned Google for many years, up hundreds of percent in some of my other accounts. And I'm starting to sell Google in some of those registered accounts and other accounts in order to buy in my unregistered account since it doesn't yield a dividend. And there's a lot of room in terms of just absolute position size on Google to trim in those other accounts, bank some 100-200% gains, and then buy these companies that pay ineligible dividends in those accounts and then hold Google here. So Google's a stock that I've been buying. I think I bought 15 shares over the last day or two. Looking to continue to buy Google shares in this account as I migrate some more of my ineligible dividends over to those registered accounts that I hold separately. Google obviously has a huge advertising business on both search and YouTube, which slowed down a bit but has started picking up again. And then the other thing about Google is they've been investing heavily in Google Cloud, has been turning out a gross margin loss for years and years and years. They actually just turned their first profitable quarter in the last quarter. So really excited to see if they're able to maintain that on the year. Even if they just break even on cloud, it would be, I believe, a multi-billion-dollar profit headwind versus last year where they lost a couple $1 billion. So really excited to see that turn from deep in the red to hopefully this year's slightly up, break even to slightly up, and then in the future really see those earnings expand, similar in the way that we've seen with other companies. Obviously, they're not to the scale of Azure or AWS with Amazon and Microsoft, but if they can even become a distant third profitable player in that space, really offers some great diversification that this company hasn't really had for a long time as being primarily an advertising business. So those were kind of the main changes that I've been making in my portfolio here. Just trying to go back a bit. Have gone through ZWB, Ryokan, A&W Royalty, added those to some of my other accounts, brought over Google more so into my unregistered accounts. And then my new buys have really been around Bank of Nova Scotia, which we looked at briefly, and also Jameson Wellness, smaller buys on Div, and Keg Royalty also I just nibbled on because the price finally went down a bit and I don't have too much of it in this account. So hope you guys enjoyed that summary. Let me know in the comments what moves you guys have been making in your accounts. And if you guys have watched the whole video, would really appreciate it if you give this video a thumbs up and also consider subscribing to the channel. We just surpassed 1,000 subscribers recently, so really appreciate having you all, and I'll see you in the next one.